Welcome to Voice Daily Finance, the most important news personalized for you every day. Supported by Voice.com.
In today's episode, you'll learn about, first, today's US market review, a market in turmoil. The Dow surges to a record high while tech stocks plunge, triggering a seismic rotation. Is this a tactical reallocation or the start of a market-wide bloodbath? Second, Anthropic versus OpenAI. The $1.4 trillion shadow war ignites. One giant projects a staggering $74 billion loss. One titan bets on profitability while its rival projects unprecedented losses. Which AI business model will survive this high-stakes battle and which is on a path to self-destruction? Finally, EV market turmoil masks truth. Toyota's $24 billion contrarian bet triggers a shocking industry reversal. While EV-only giants stumble, Toyota's once criticised hybrid strategy is rewriting the rules of the auto industry. Who will be left behind in this historic power shift? Battle stations. The markets are in turmoil as investors scramble to reposition ahead of today's US government shutdown resolution. The Dow has surged past the 48,000 mark, setting a record close, while the Nasdaq took a hit, down 0.3% as tech stocks faced a valuation reset. This is a market on the edge, and I'm telling you, now is the time to act. Here's the lay of the land. The US equity market is at a critical juncture. The S&P 500 closed up a modest 0.1%, but don't be fooled beneath this calm facade. There's a seismic shift occurring. Investors are rotating out of high-flying tech stocks and piling into financials and healthcare. It's a decisive moment driven by four key factors: the looming end to the 42-day government shutdown, a deteriorating labour market with private sector job losses accelerating, a 68 to 69% probability of a Federal Reserve rate cut in December, and a marked sell-off in overvalued AI stocks. This isn't a crash, folks. It's a tactical reallocation opportunity. Let's dive deeper. The pending government shutdown resolution is a game changer. Historically, markets rally post-resolution with average gains of 1.2% in the first month and 2.9% in 3 months. This is your chance to capitalize on the expected surge in government spending and corporate investment. But here's the kicker. Economic data is showing cracks. The ADP report revealed significant job cuts and consumer sentiment is at historic lows. These are clear signs of economic strain, making a Fed rate cut in December all the more likely. Now, let's talk money flows. Capital is rotating fast. Tech heavyweights like Nvidia and Palantir are under pressure. Nvidia, down 3%, was hit by SoftBank's massive $5.8 billion stake liquidation. This move signals a broader AI valuation reset. On the flip side, financials are thriving with Goldman Sachs and United Health leading the way, each up over 3.5%. The sector's strength is buoyed by expectations of wider net interest margins amidst a higher for longer rate scenario. Valuation-wise, tech stocks are facing a reality check. Nvidia's sky-high P divided by E ratio is under scrutiny, while AMD's strong earnings have propelled its stock up 9%. This is a sector differentiation event. Investors are favouring companies with solid earnings over speculative plays. The S&P 500's resilience hides these underlying shifts, but don't be complacent, the market's breadth is narrowing, and that's a red flag. Good advice makes you rich, bad advice costs you a fortune. Listen to me, here's how to play it. Short term, rotate out of overvalued tech stocks like Nvidia and Palantir, trim these positions by 15 to 20% and rebalance into AMD and semiconductor ETFs like SOXX. Target AMD at $350. It's your opportunity to ride the AI infrastructure wave at a reasonable valuation. Medium term, increase your exposure to financials and healthcare. Add 2 to 3% to sector ETFs like XLF and XLV, capitalizing on their defensive nature and growth potential amidst economic uncertainty. For a defensive hedge, consider increasing bond allocations. With the 10-year Treasury yield at 4.06%, there's room for capital gains if the Fed cuts rates in December. Use intermediate-term Treasury ETFs like IEF to capture this upside. But don't forget the risks. If Nvidia breaks below $175, accelerate your tech trim. Keep an eye on the 10-year yield. If it spikes above 4.3%, tech stocks could face further pressure. And as always, hedge smartly. For advanced investors, consider option strategies like buying puts on high volatility tech stocks. For intermediate players, sector rotation remains a robust strategy. Basic investors, maintain a cash buffer to seize buying opportunities post-volatility spikes. In closing, time's ticking. The government shutdown resolution is imminent, and markets are poised for a significant shift. Keep your eyes on the Fed's next move and the initial wave of post-shutdown economic data. Your strategy today can set the tone for months to come. Listen to me, follow this framework, and you won't lose. Now let's examine today's key news stories. AI powerhouse Anthropic just dropped a bombshell, pledging a massive $50 billion for a US artificial intelligence infrastructure build-out. This kind of spending has implications that stretch far beyond the tech world. It's what economists call non-residential fixed investment, basically. Companies spending on new structures and equipment. And here's a crucial point. This AI-driven capital expenditure boom is becoming a primary engine for the entire US economy. This spending could significantly boost headline GDP growth, much like the shale boom did for specific regions, but it also risks creating targeted inflation in sectors like construction and, most critically, the power grid. A while back, we also flagged that much of this build-out leans on debt, so the real test is whether these assets can earn before the funding runway shortens. But in the high-stakes war for AI supremacy, that's just the opening shot. Its chief rival, OpenAI, has already secured over $1.4 trillion in long-term infrastructure commitments through deals with giants like NVIDIA, Microsoft, and Amazon. Continuing our last discussion about tech giants ratcheting up capital expenditure, the latest development is that the bar for table stakes keeps moving higher. Now, get this. This isn't just a corporate rivalry. It's a uniquely American private sector-led race for what's called sovereign AI. We're seeing this market-based approach in the US, while at the same time, China is taking a completely different path with its predominantly state-driven strategy. Recent data shows that in 2024, US private AI investment hit nearly $110 billion, which is almost 12 times China's $9.3 billion in the same period. For listeners who remember our segment on China's Eastern data, Western computing, this divergence in models is exactly what we meant by a geopolitical data center race. This isn't just a spending race. It's a battle for survival, and the financial filings tell a shocking story. While Anthropic serves over 300,000 businesses and has seen its large accounts grow sevenfold in the past year, its financial projections are the real headline. Internal documents show Anthropic expects to break even by 2028. As we've discussed before, the crucial marker isn't just reported profit, it's whether free cash flow turns positive fast enough to support debt-heavy build-outs. What really brings this to a head is how it challenges the growth at all costs narrative dominating the AI sector. Anthropic's enterprise-focused strategy, where it gets 80% of its revenue from business clients, is becoming a key indicator of a sustainable AI business model. If they succeed, it could trigger a major market repricing of AI valuations, shifting the focus from user numbers toward actual profitability. We previously highlighted how rising depreciation can flatten net income while cash generation lags. So if Anthropic really hits break even on a cash basis, that's the signal to watch. In that same year, OpenAI is projecting a staggering $74 billion in operating losses. A few days ago, we mentioned that when companies repeatedly need more cash than they admit, it can put acute pressure on funding timelines. Exactly why these loss trajectories matter for anyone underwriting the next leg of the AI boom. This financial divergence is happening as the physical arms race accelerates. Anthropic is launching custom data centers in Texas and New York in partnership with FluidStack, and Amazon has already opened a dedicated $11 billion campus for them in Indiana. That facility is already up and running, while many competitors are still promising data centers of the future. We previously walked through how interconnection queues like MESOs are jammed and natural gas turbines are largely sold out for the decade. So projects that are live or shovel ready have a real advantage. However, if you zoom out, you'll see a huge bottleneck that many are underestimating. Electricity. The massive power demand from these new AI data centers is, believe it or not, becoming the primary physical constraint on growth. The International Energy Agency projects that by 2030, global electricity demand from data centers will more than double, consuming an amount of power equivalent to all of Japan's current usage. To connect this with our earlier US specific discussion, research points to data centers climbing from 3.7% of US electricity use in 2023 to roughly 11.7% by 2030, with around 60 gigawatts of new demand on the way. For balance, we also noted the CEO of Constellation Energy cautioning that the load is being overstated, underscoring how uncertain these projections remain. Meanwhile, the sheer scale of this spending is forcing a political showdown. OpenAI recently asked the Trump administration to expand key CHIPS Act tax credits to cover AI data centers. That request followed intense backlash over earlier suggestions of a potential government backstop for its massive compute deals, underscoring the uncertainty of who will fund America's AI future. And as we discussed a while back, export controls and the rise of sovereign AI are reshaping demand signals. Some of today's chip buying may also reflect strategic hoarding ahead of tighter restrictions, which complicates how policymakers interpret the need for subsidies. The battle for AI dominance is now being fought on two fronts, one defined by $1 trillion spending spree backed by potential government support, and the other by a disciplined path to profitability and independent execution. So where do we go from here? The real indicator is energy. Keep an eye on the capital expenditure plans of major utility companies and watch for spikes in regional power prices, especially in areas with new data centers. Add to that the pace of interconnection approvals and whether gas turbine supply constraints start to ease. Those will be the most reliable leading indicators for the true pace of AI deployment. The future of AI isn't just being written in code, but also on the balance sheets of power companies and in the blueprints of our national energy grid. Speaking of massive capital investments reshaping American industry, let's turn to the auto sector. The story begins with a decision that caught everyone by surprise. Toyota just dropped a 1-2 punch on the auto industry. The company has officially started production at its massive $13.9 billion battery plant in North Carolina. And before the dust even settled, it confirmed plans to pour another $10 billion into its US operations over the next 5 years. This isn't just about building factories. It's a major corporate bet on the US as a stable manufacturing hub. And the scale of it is staggering. A big part of the calculation here is the powerful US. Industrial policies like the Inflation Reduction Act or IRA. For example, the IRA offers a tax credit of $35 for every kilowatt hour of battery capacity produced in the US. That's a huge incentive, making these massive investments financially attractive. Essentially, Toyota is locking in long-term production in the US to de-risk from potential supply chain disruptions and geopolitical tensions elsewhere. This isn't just an expansion, it's a strategic masterstroke. The facility is Toyota's first in-house battery plant outside of Japan, a project set in motion amid a major push to onshore production. This is where the situation takes a more complex turn. For decades, Toyota was the king of lean outsourcing, relying on a network of external suppliers to keep costs down and stay flexible. By building its own battery plant, it's making a huge pivot toward what we call vertical integration. It all boils down to one word: control. They are bringing critical technology in-house, much like Tesla did. This move gives them more control over their supply chain, technology, and costs, but it also puts pressure on traditional battery suppliers like Panasonic and China's CATL. If that was just the appetizer, the main course is just being served. At the exact moment, the market for all electric vehicles is reportedly souring, demand for hybrid vehicles is exploding. Actually, the entire industry is seeing this shift. While other automakers are grappling with slowing EV sales, Toyota is capitalizing on a market it completely dominates. The company controls over 51% of all US hybrid sales. For instance, research firm JD Power recently had to lower its US sales forecast for pure EVs, citing slower than expected growth. Even Honda has announced plans to double its hybrid sales. What Toyota did so brilliantly was to treat hybrids as a strategic hedge. While many others went all in on a pure EV future, Toyota bet that consumers would want a bridge technology, and that bet is now paying off massively. That market dominance is translating directly to the bottom line, with Toyota's US sales already up nearly 10% this year, topping 1.3 million vehicles sold. This isn't just about building cars, it's about navigating a complex landscape of shifting consumer tastes, regulatory changes, and international trade pressures. The North America CEO for Toyota Motor is calling this a pivotal moment for the company. The message from the world's largest automaker is clear. While much of the industry was chasing an all-electric future, Toyota played the long game with hybrids. With billions now committed to its American manufacturing footprint, that contrarian bet is actively reshaping the US auto market. So, what are the key signals to monitor going forward? First, keep an eye on the labour market in the US, Southeast, a region now being called the Battery Belt. This massive influx of investment is going to create a huge demand for skilled technicians, and we could see localised wage inflation as companies compete for talent. Second, watch the sales figures. Will the trend of strong hybrid sales and softer EV demand continue? This will be a key indicator for the stock performance of automakers. For Chinese audiences, this trend is particularly important. As global automakers like Toyota bring more battery production in-house and onshore it in the US, it could reduce their reliance on major Chinese battery suppliers like CATL, potentially reshaping the global supply chain.
That's it for today on Voice Daily Finance. Follow, share, and stay tuned for daily updates coming your way tomorrow.